Good morning, everyone, and welcome. I call this meeting of the NCUA Board to order. I want to note for the record that due to the COVID-19 pandemic, today's meeting is open to the public through a live webcast only. The public may access the meeting by visiting the agency's homepage at www.ncua.gov and clicking on the provided webcast link. I would also like to note that all participants in today's webcast meeting are participating remotely. So if we experience any technical difficulties, I ask for your patience. This week, we marked the one-year anniversary of the NCUA team working in a remote posture because of the COVID-19 pandemic. None of us could have anticipated the extraordinary circumstances in which we found ourselves during the last 12 months. Yet, NCUA employees and federally insured credit unions have each exhibited tremendous resilience under some of the most trying circumstances. Before we continue, I would like to engage in a moment of silence in memory of those who we have lost, including those members of the NCUA family to COVID-19 and those Asian Americans targeted in race and violence and harassment since news about the virus began appearing in U.S. media outlets. To those members of the NCUA team who are listening from their home offices, thank you for your good work and for supporting your colleagues amidst the crisis. Although I miss working with you by your side in the central office, I look forward to seeing you in person again only when it is safe to do so and not a moment sooner. And to those of you working at federally insured credit unions across our country, thank you for serving as financial first responders. Your work is helping your members handle countless pandemic-induced economic challenges. I have always been incredibly proud of the credit union movement, never more so than now. Late last week, millions of credit union members began receiving stimulus payments through the American Rescue Plan. Lawmakers intended for consumers to spend these checks on necessities like food, shelter, utilities, and medical care. However, because the new law lacks necessary guardrails, I am very concerned that some financial institutions may soon make short-sighted decisions to use these stimulus funds to instead pay for overdraft fees, outstanding debts, and other liabilities. Financially stressed Americans deserve better treatment. As financial first responders who support their members in times of need, many federally insured credit unions have already voluntarily decided to protect their members' relief payments from collection, garnishment, and right of offset. By demonstrating the cooperative philosophy at the heart of the credit union movement, these credit unions are doing the right thing. And as American consumers, many of whom are disproportionately people of color, struggle through the economic shock inflicted by the COVID-19 crisis, all credit unions should strive to live up to that foundational principle. That concludes my remarks, and I know my fellow board members would like to make remarks on this anniversary as well. Vice Chairman Hoffman, you are recognized.
Thank you, Chairman. It's remarkable and sad that we're still here a year later. I'll admit that when my former boss in the Senate said in January 2020 that the coronavirus would become the biggest story in the world that year, I didn't know if it would get that serious, but he was right. I have two main comments. First, I know everybody at NCUA is focused on helping middle-class people participate in the economic recovery, especially given that this recovery has been bifurcated. On the one hand, there's those whose stocks and real estate have soared in value and are more likely to be able to work from home and keep getting a paycheck the whole time, because we're part of what's called the Zoom class of workers. Further up the financial scale, we know places like Nantucket and the Hamptons have been packed since the pandemic started, full of the sort of people who use the word summer as a verb. On the other hand, cab drivers, factory workers, waitresses, they can't work from home, and they likely haven't seen six-figure jumps in their portfolios. Not to mention, it's also not random regarding who's been the victims of both the virus and of the lockdowns. I'm referring to the awful news around the large spike in homicides and in relapses and overdoses, especially for those who've relied for years on in-person meetings for groups like Alcoholics Anonymous or Narcotics Anonymous. There's also been harm to our youngest and oldest Americans. Many children, depending on where they live and their parents' wealth, have fallen back in their education, not to mention issues like increased self-harm. And there's major problems among the elderly, even those who didn't get COVID. I'm reminded here of people like my father who had dementia, folks whose cognitive abilities decline and mental health suffers without frequent in-person interaction. So I'd just like to reiterate that as life goes back to normal, NCUA is committed to doing its small part in boosting the have-nots. The second thing is perhaps some good news, and that we've all experienced a one-year experiment in new ways of doing things, and some of those things will be useful going forward. In some ways, the pandemic just hit fast forward on trends that were happening anyway, like virtual meetings, shopping online, working from home. Thus, I've been pleased to see that NCUA is, just like most organizations, reviewing what we've learned from these experiments, things like doing virtual exams for credit unions. So I think we all agree that we sure deserve some upsides from this pandemic. That concludes my comments. Thank you, Mr. Chairman.
Well said, Vice Chairman Hoffman. Board Member Hood, do you have any remarks?
Yes, good morning, and thank you, Chairman Harper, for giving us the opportunity to offer some additional thoughts on this one-year anniversary of the COVID. Since we're all in a remote environment, I am here in North Carolina today, where it was reported yesterday that more than 1,000 people are hospitalized with coronavirus infections. That's still an alarming number, but the same report notes that the numbers are greatly reduced from January, just 2 months ago, when more than 4,000 North Carolinians were hospitalized with the virus. Meanwhile, I understand that more than 3.4 million doses of the COVID vaccine have been administered here in my home state, and 1.3 million people here are now fully vaccinated. Those numbers will only increase in the days and weeks to come. In fact, one of the reasons I am calling in today remote from my home in North Carolina is that I am eligible to get vaccinated later this week, and I look forward to it. Many of you are probably seeing similar trend lines in your own states and communities. And while we're not out of the woods yet, we should at least pause to note that this is real progress. I believe we are winning this fight, and there are reasons to be optimistic. Now compare that to where we were a year ago this week. It's easy to forget how much uncertainty and foreboding we were all facing as an industry. Each day brought news of the virus, which was still little understood, spreading more rapidly and widely, and the forecasts of what was to come were, to say the least, anything but reassuring. And that was just at the beginning of what would be an extraordinarily difficult year, marked not only by the pandemic, but also a sharp economic contraction, civil unrest sparked by deep concerns over social justice and the horrific death of George Floyd, and a widespread sense of anxiety. Yet against that difficult backdrop, NCUA stood strong as an agency, but more importantly, so did the credit unions. As NCUA chairman last year, I was encouraged and inspired to see how effectively the agency's workforce responded to the serial challenges we all confronted. As we shifted to an off-site work posture, NCUA employees responded with purpose, resilience, and creativity, while continuing to execute our regulatory mission. In a time of uncertainty, the agency moved forward with a sense of purpose and resolve to keep the credit union industry safe and sound. Likewise, I'd now like to salute our credit union industry leaders and employees. Your commitment to the needs of your member owners, your co-workers, and your communities was steadfast. The industry's performance under the last year's stress test was outstanding. You made prudent moves to keep your employees and member owners safe without disrupting services. Your members were able to maintain access to credit and the affordable financial services they rely upon at this time, especially when the need is greatest. When the CARES Act was enacted and we needed to distribute funds under the Paycheck Protection Program, credit unions rallied to the cause and made more than 171,000 loans to entrepreneurs and small businesses that were in urgent need of credit to keep their doors open. As a result of those moves, the initial economic damage from the pandemic was severe, but we at least managed to mitigate it. I'll repeat, it's not over. We are still monitoring the situation to assess the damage to the economy, and we still have a long way to go to restore what's been lost in terms of jobs, small businesses, and local investment. We're paying close attention to what additional support might be needed for smaller credit unions and minority depository institutions, because we know they are still vulnerable to additional shocks. And we still have a great deal of work to do to address the challenge of financial inclusion for all Americans, which last year I identified as a leading priority for this industry, as did the agency's senior executive staff last year during a strategic planning meeting. I'm proud of the work that's been done with the board to get the Access, Advancing Communities Through Credit, Education, and Stability initiative started. And I look forward to work with my fellow board members, with the NCUA staff, and with the industry to continue advancing these vital priorities. Mr. Chairman, I'd like to also thank you for your continued support of the Access Initiative and the building upon the work we did together last year in advancing these important initiatives. So as I've mentioned, the challenges are still with us, but we have made undeniable progress. Many of you may be familiar with the Winston Churchill's famous quote from 1942, as forces finally began to turn the tide in World War II. The Prime Minister reminded his people that, and I quote, "This is not the end. It's not even the beginning of the end, but it is perhaps the end of the beginning." As that quote reminds us, in any struggle, we should be hopeful and optimistic that we will prevail. But hope and optimism have to be earned. So we should move forward with a sense of clarity and reality, recognizing that we still have much hard work and many challenges ahead. And we should recognize that credit unions are well positioned to respond to the needs at this very important time in history. Thank you, credit union system. Thank you, NCUA colleagues, and thank you very much, Mr. Chairman. This concludes my remarks.
Thank you very much, Board Member Hood, for those thoughtful comments and remarks. I have to say that the Churchill quote that you used is one of my favorite, and I agree it is a powerful one. I also should thank you for your leadership during the past year. I know that being chairman of the agency carries a heavy burden, and you wore it extremely well during the time of crisis as we began going through this. And you have my full commitment to continue working on matters of economic equity and justice so that we can advance opportunity for all within the credit union system. With that, the first item on our agenda is Interim Final Rule, Part 725, the Central Liquidity Facility. Presenting staff are Justin Anderson, Senior Staff Attorney, Office of General Counsel, and Anthony Capetta, Supervisory Financial Analyst, Office of Examinations and Insurance. Gentlemen, you may begin when you're ready.
Good morning, Chairman Harper, Vice Chairman Hauptman, and Board Member Hood. This is Anthony Capetta, the Vice President of the Central Liquidity Facility. Enacted on March 27, 2020, the Coronavirus Aid, Relief, and Economic Security, or CARES Act, made several temporary but substantive changes to Title III of the Federal Credit Union Act, which governs the Central Liquidity Facility. As a reminder to our listeners, the Central Liquidity Facility, or CLF, is a mixed ownership government corporation created to improve the general financial stability of credit unions by serving as a liquidity lender to credit unions experiencing unusual or unexpected liquidity shortfalls. Member credit unions own the CLF, which exists within the NCUA, and the CLF group manages the facility under the oversight of the NCUA board. The changes to Title III of the Federal Credit Union Act were to sunset on December 31st of 2020. However, the Consolidated Appropriations Act of 2021 extended them until December 31st, 2021. These changes include increasing the CLF's maximum legal borrowing authority, permitting temporary access for corporate credit unions as agent members to borrow for their own needs, providing greater flexibility and affordability to agent members to join and serve smaller groups of their covered institutions rather than their entire memberships, and providing the NCUA board with more clarity and flexibility regarding the loans it can approve by removing the phrase, quote, "The board shall not approve an application for credit with the intent of which is to expand the credit union portfolios," close quote. Additionally, on April 13, 2020, the NCUA board approved an interim final rule to make enhancements to the NCUA's CLF rule, Part 725, and cohere the regulation with the statutory changes in the CARES Act. These regulatory enhancements, two of which are permanent, provided flexibility, relief, and clarity for credit unions. In addition to cohering changes, the NCUA's regulatory changes included eliminating the 6-month waiting period for new members to receive a loan, easing collateral requirements for certain assets securing loans, and temporarily changing the requirements for a credit union to terminate its membership. To provide additional clarity to all stakeholders, the rule we are presenting today updates the CLF regulation to align the sunset dates with those of the Consolidated Appropriations Act and coheres the expiration of the temporary termination provisions within the statute. I will now hand things over to Justin Anderson to walk you through the recommended changes to the CLF rule, Part 725. Justin?
Thank you, Anthony. Good morning. This is Senior Staff Attorney Justin Anderson. As Anthony mentioned, I will briefly discuss the changes made in this interim final rule to the CLF regulation, Part 725. These changes, in large part, are simply changes to the sunset date in Part 725 to reflect the extension of the CARES Act sunset dates by the Consolidated Appropriations Act of 2021. The sunset date was extended from December 31st, 2020 to December 31st, 2021. Specifically, the sunset date extensions made by this interim final rule relate to the following amendments made by the board in April of 2020. First, the amended definition of liquidity needs to remove the words primarily serving natural persons. Second, the amended structure of the requirement for a corporate credit union to subscribe to the capital stock of the facility, which allows the board in its sole discretion to determine which grouping of natural person member credit unions of the applying corporate credit union are considered covered by the agent's membership in the facility. In turn, this approved group is the basis for calculating the amount of facility capital stock the corporate credit union is required to purchase. Third, the clarifying amendment to Section 725.4 that permits an agent member to borrow from the facility for its own liquidity needs. But to do so, it must first subscribe to the capital stock of the facility in an amount equal to 0.5% of its own paid-in and unimpaired capital and surplus. And fourth, the amended waiting periods for a credit union to terminate its membership in the facility during the period in which the statutory CLF enhancements are in place. In addition to these date extensions, this final rule would also make technical changes to 2 sections of the CLF regulation relating to loan applications and underwriting. These technical changes would clarify that these sections apply to corporate credit unions borrowing for their own liquidity needs during the periods under which such credit unions are authorized to borrow from the facility for their own liquidity needs. These changes will help ensure clarity and consistency in Part 725 of the NCUA's regulation. This concludes our presentation, and we are happy to answer any questions. Thank you.
And thank you, Justin, as well as to you, Anthony, for your presentation on the interim final rule and request for comment on enhancements to the NCUA's central liquidity facility. I appreciate your good work on these important matters. The board is issuing this interim final rule to provide clarity and transparency for all stakeholders. These regulatory changes address the potential economic disruptions the COVID-19 pandemic could cause and conform the NCUA's regulations to extensions of statutory enhancements recently enacted in the Consolidated Appropriations Act at the end of 2020. Throughout the COVID-19 pandemic, two of my top priorities have been, and will continue to be, ensuring that credit union members are protected and that the credit union system remains strong. In December, Congress enacted the Consolidated Appropriations Act, which included pandemic relief for credit unions and their members. The NCUA board and staff worked closely with congressional offices to receive this much-needed relief. Specifically, the year-end funding bill extended several enhancements to the CLF, which were first enacted in 2020 as part of the CARES Act. These enhancements were scheduled to sunset on December 31st, 2020, and I appreciate Congress extending them to the end of 2021. With these reforms in place, the facility's lending capacity has tripled to more than $33.6 billion since the start of the pandemic in March 2020. These temporary changes make it easier for credit unions to join the CLF, including corporate credit unions to act as agents for consumer credit unions as they once did before the 2008 financial crisis. These enhancements also ease some restrictions around getting a liquidity loan and temporarily increase the facility's borrowing capacity from 12 times its capital to 16 times its capital through the end of 2021. When confronted with the early stages of the COVID-19 pandemic 1 year ago, we experienced in real time considerable turmoil in our markets. The NCUA needed to ensure that credit unions would have access to liquidity if other parts of our economy froze up. So I, along with my fellow board members, focused on mission-critical services aimed at containing those risks and called on the NCUA to seek legislation to enhance the capacity and powers of the CLF. NCUA experts worked swiftly to develop a proposal and educate lawmakers about the need for these reforms. I am grateful for their actions. Congress also acted quickly to adopt those temporary enhancements, and the NCUA staff then acted expeditiously to draft an interim final rule to implement those important reforms. The board then voted in April 2020 to issue that initial rule to provide credit unions with greater access to liquidity. Today, we are extending that interim final rule to ensure that credit unions remain on a strong operational footing during the COVID-19 pandemic's economic fallout. The temporary changes and increased flexibilities provided by Congress to the NCUA's CLF are very useful, but in my view, we should pursue permanent reforms. Anytime there are economic contractions, we can expect credit unions' liquidity needs to arise. Those liquidity needs may spike after the current expiration date of these statutory changes, or they may jump during a future economic crisis. As such, I will continue to urge Congress to make the CLF provisions first incorporated into the CARES Act permanent. Permanence would provide regulatory certainty during the current crisis and bolster the credit union system's ability to respond to future emergencies. Lastly, I strongly encourage all consumer credit unions that do not already belong to or have access to an agent for the CLF to join the facility. In doing so, they will be demonstrating the best of the cooperative movement. This concludes my remarks. I now recognize Vice Chairman Hauptman.
Thank you, Mr. Chairman. As we've just heard, the CARES Act made critical amendments to the CLF provisions of the Credit Union Act. In April 2020, the board approved the interim rule that supplements the legislative changes resulting from the CARES Act. The interim rule enhanced the ability of the CLF to serve as a liquidity backstop for the nation's credit union system. It made it easier for credit unions to join the facility as a regular member or through a corporate credit union as part of an agent relationship and access emergency liquidity should the need arise. The rule also relaxed the withdrawal requirements. Today's proposed rule simply amends the CLF regulations to reflect the extensions enacted by the Consolidated Appropriations Act of 2021. I will be supporting it. I'm fully aware that right now most credit unions are awash in short-term liquidity, so today's proposed changes may not attract a lot of attention, but if 2020 taught us anything, it's that circumstances can change quickly. During the April 22 board meeting, all 3 board members urged credit unions to join the CLF. While I echo their appeal, I'd like to emphasize our responsibility to ensure the CLF is a compelling option for credit unions of all sizes. Formed in 1979, when credit unions could not join the Fed, Congress knew that having a reliable source of liquidity would improve the financial stability of credit unions in general. And just a few years after its formation, the CLF proved its worth during the Penn Square crisis and helped prevent the failure of over 150 credit unions. So as a mixed ownership government corporation, the CLF is managed by NCUA. Credit unions supply the capital upon which its borrowing capacity is determined. The CLF source of funding is direct from the government's federal financing bank, unlike the Federal Home Loan Bank, which raises its borrowings in the open market. In a crisis, borrowing directly from the federal financing bank is an important distinction. The CLF can be a powerful tool in an emergency, but we should plan now. Ensuring the CLF is fully prepared for the future will require making it useful to credit unions of all sizes. This can only be done with focused and full-time leadership. I should mention that the role of CLF president is unfilled at this time, and while I'm grateful to our staff for their management, the CLF should not just be another project, and I know the chairman agrees we should begin the work of filling the position of president of CLF as soon as possible. Mr. Chairman, that concludes my remarks, but I do have a couple questions. One question for you guys. Credit unions who are members of the mixed ownership corporation have the same rights that we expect credit union members to have in the corporate governance of credit unions?
Hi, this is Anthony Capetta. No, they do not. The CLF is run by the NCUA board and administered through the NCUA staff. Congress was very clear in giving the NCUA board solely the authority to prescribe the manner in which the general business of the facility is conducted, prescribe the rules and regulations to carry out the statute, and determine expenditures incurred by the administration to carry out the statute, as well as annually assess the facility and administration accordingly. In that structure, in the structure we operate under, the mixed ownership, it does not confer governance, but instead access to the liquidity.
I hear you on that. I guess my question is, some credit union, the members individually supply the capital for the credit unions that they're members of. Just trying to get the CLF governance to be as close to what credit unions are used to. They supply the capital as well. And you're right, it does not require it, but just trying to see if we can make the governance as similar to what credit union members are used to in their own credit unions. Does that make sense?
It does. And the distinction here is that generally when we think of corporate governance of credit unions, we think of the processes by which the board of directors direct and control a credit union, the process and procedures by which the credit union complies with legislative and regulatory requirements, and processes by which fiduciary responsibilities are carried out on behalf of the credit union's membership. But with the CLF, per statute, all control and governance is ceded to the NCUA board, and who within the NCUA, it chooses to delegate those responsibilities to.
I understand that. I'm just making the point, I think, that you're right, it does, the board does have the ability to determine the governance, but we can then use that power to make it more similar, if we wish, to what credit union members are used to. I guess what I'm trying to get at here is people are used to sometimes the government demanding things of the private sector that government itself does not follow, all the while saying the private sector should do these things because it is fair and right and good governance. That's all. I'm just trying to make sure that that is just an issue that we hear across government in general. I'm not talking about NCUA in particular. For the record, for any credit unions listening today that's a member of the CLF through agency membership, can you just discuss how corporates disseminate liquidity for agent members? I guess the main thing they think about is timing. Can it be done quickly, or is the borrower going to have to excuse, you know?
Happily. Let me preface what I'm about to say with the fact that the process by which a member of an agent group obtains an advance from the CLF is described in detail in the CLF operating circular dated April 2020, agent lending process that's available on the NCUA website. So that's a reference for members to go to. Having said that, when an agent member receives an application from one of its member natural person credit unions for an advance to meet liquidity needs, the agent reviews the application and determines if the applicant's creditworthiness and the liquidity criteria meet the CLF policy requirements. Subject to that review, the agent will accept or deny the loan and submit a request to the facility for an advance for accepted loans applications. All accepted advance applications for member natural person credit unions are submitted to the CLF on an agent request for funds form. The CLF reviews the agent request for funds for completeness, informs the agent if more information is necessary, and if deemed complete, whether the loan is approved. If necessary, agents are ready to act quickly, and the CLF must confirm or reject any accepted loan applications from those agents within 5 business days. So with respect to the timing issue, the facility's goal is to make a best efforts turnaround time on all facility advances, and the borrower is not required to prove that it's exhausted any other avenues. However, the timing of the delivery of the requested advance is a function of the amount requested and how quickly the Federal Financing Bank can get that funding to us under our note purchase agreement, as they must issue an associated amount of Treasury debt. So as I outlined in the operating circular I had mentioned, for up to $500 million requested, the maximum delivery time is 3 business days. And for advance requests of $500 million to $2 billion, the maximum delivery time is 5 days. And anything over equal to or greater than $2 billion, the maximum delivery time is 10 business days.
That is a thorough and excellent explanation. I have no further questions. Thank you.
Thank you very much, Vice Chairman Huffman, and I agree that we should be working to fill the CLF position as the president as quickly as possible. A permanent person in that position would provide greater certainty and direction for the organization. Board Member Hood, do you have any comments or questions?
Yes, thank you, Mr. Chairman, and also thank you, Justin and Anthony, for your presentation this morning. Right now, we are clearly facing an unprecedented disruption to our economy. We do not know for sure how the situation is going to unfold and what the fallout may be. It's difficult to forecast. However, we must take steps to preserve our system's capacity and to safeguard its members. You all, these few sentences were said by me not earlier in this month of March 2021, but actually during the NCUA board meeting in April 2020. I'm not sure any of us knew then that that would be a year followed by COVID-19 pandemic spreading throughout the country as it has today. Today, as the Vice Chairman noted, and I want to note as well, the credit union system is in fact awash in capital and also liquidity. Another stimulus will be hitting many members' accounts soon if they haven't already. But as I've said before, we should prepare for the worst and hope for the best. One of the best ways for the NCUA to prepare for the worst and hope for the best is to have a robust central liquidity facility. Today's interim final rule before us is largely a technical update to the NCUA regulations, given that the CLF was extended temporarily a second time by Congress. Thanks to the changes made by the CARES Act last year and subsequent action by Congress to extend the CLF provisions beyond the initial sunset of December 31st, 2020, the CLF's borrowing capacity has increased significantly. I was glad to work along with Chairman Harper and Vice Chairman Hauptman to get the CLF provisions extended by Congress again, albeit temporarily. But I do think it is appropriate to note that I too believe these changes should be made permanent, and I pledge to work with my fellow board members in that regard, and I know the chairman shares this regard as well. If this pandemic turns into an economic crisis and then a liquidity crisis, which we don't see at present, the credit union system is in a much better place than it was before the CARES Act CLF provisions were enacted. In fact, the NGN briefing we'll have later today is a reminder of a liquidity crisis and what can happen. When the next liquidity crisis does come, and if it does, we just don't know when and we don't know what will cause it. We need to be prepared. Let's look at the facts. In March 2020, the CLF had 279 regular members and $7.5 billion in borrowing authority. And while the CARES Act did increase the borrowing multiplier to 16 times the CLF, I want you all to know I did ask for much higher than that, but we do have it at 16 times that. The credit in this growth really should go to the credit unions because the cooperative system really stepped up to the plate, just as I expected they would do. Credit unions didn't join the CLF by regulatory fiat. They joined voluntarily in the cooperative spirit of people helping people. And in that particular case, credit unions helping credit unions, natural persons and corporate credit unions alike, and ultimately helping member owners should a liquidity crisis arise. Since the changes made by the CARES Act, as of March 12, 2021, this year, the CLF has 71 new regular members and 11 new agent members. The 11 new corporate credit union agent members represent an additional 3,762 natural person credit unions. In total, 4,110 credit unions are either CLF members or represented by an agent member. And I would be remiss if I did not take this opportunity to thank Owen Cole, who has since retired from the agency, and Anthony Capetta for the key role they both played in enacting the CARES Act changes here at NCUA. I now just have a few quick questions, and one is for the record, could someone answer whether or not the CLF is backed by the U.S. government? And if not, how do we manage this?
Hi, this is Anthony. I apologize for that. I had a little technical issue. The CLF is not explicitly backed by the U.S. government. However, the Share Insurance Fund, which is backed by the full faith and guarantee of the U.S. government, can provide guarantees to the CLF and provides a dimension of safety. Member capital contributions in the CLF are at very low risk for several reasons. The CLF underwriting policies do not allow it to lend to members that do not meet creditworthy standards. Also, the advances are fully collateralized with marketable instruments that are subject to collateral margin requirements. And the CLF also has discretion in the amount and tenures of the advance.
Great, thank you, Anthony. And I do have another question, and that is, how do we go about soliciting and listening to feedback of our stockholders and shareholders in the CLF?
Yes, hi. The CLF has an active engagement with the credit unions and its members in soliciting feedback. We provide a significant amount of high touch, if you will, with the credit unions from throughout the life cycle of their membership in the CLF. It begins early on with our welcoming of them and providing a welcome statement. We often provide with their dividend statements information with their annual adjustments information, where we will interact frequently with them. The CLF are active listeners, and we have a robust dialogue with them for those, especially those who choose to contact the CLF. And we are available, of course, through email and telephone, and all the CLF members have spoken with different credit unions on all of these issues. In addition, we have conducted numerous webinars, participated in industry trade association meetings, and the CLF maintains several pages on the NCUA website that we update frequently, and they contain CLF frequently asked questions, press releases, letters to credit unions, the operating circulars that govern how we operate, and their forms, as well as the monthly financial reports, and those are posted going back for the last 10 years.
Great, thank you. And Anthony, as a follow-up to that question, could you please let me know if there's ever been a stakeholder report published, or stockholder for that matter?
I am not aware. The bylaws, specifically Section 6.02, reports to stakeholders, states that, quote, the board may cause to be sent to the shareholders annual or periodic reports in such forms as may be deemed appropriate by the board, close quote. Although I'm not aware of any such communications from the NCUA board to shareholders in the recent years, the CLF does provide a significant amount of information, as I just discussed, and is very open and transparent with our operations.
Great. Well, Anthony, thank you for that response, sir. And I must just say that with 80% of our credit unions now actively engaged with the CLF, that over 4,100 of them, I certainly would champion the agency doing a report and somehow just continuing to have transparent dealings with our CLF members. So I certainly would like to be one to champion that and encourage perhaps our board and agency leaders to look into bringing something such as that to fruition. And I do just want to close with one additional question, and that is going back to one of the items you mentioned regarding CLF bylaws. This, though, is a question regarding dividends. According to the bylaws, I believe it says that dividends shall be declared and paid no less frequently than annually at such times and in such amounts as the board may determine. Any idea as to when the last time the board took up this matter?
I am unaware when the last time the NCUA board took up this matter, and I will have to check with the board secretary when this was done last. However, I'll note that per the NCUA board delegation CLF-5, and that's dated January 29th, 1996 by notation vote, and November 24th, 1997 by closed board meeting. The president of the CLF has the authority to set the CLF dividend rate on a monthly or quarterly basis in order to distribute the CLF net income to its members. The CLF produces and publishes on, as I mentioned, on the NCUA website, the monthly financial statements, and each quarterly statements reports the dividend paid to the members.
Great. Well, thank you again, Anthony. And again, I certainly want to champion us doing a report. As you would imagine, many of our publicly listed companies, not that we're publicly listed, but any of our companies that have stock in the public domain and private sector issuing such reports. I certainly hope that you can perhaps take that up. That's a best practice. And I'm glad that you mentioned the CLF president. And I want to commend and thank Chairman Harper and Vice Chairman Hauptman for agreeing with me that we do need to have a CLF president as soon as possible. And that's merely, in my opinion, you all, is that the CLF now has over $1 billion in assets and just over $1 billion in equity. This clearly is a substantial sum of money, and we certainly need to have someone who's devoted to it full time, as opposed to it being a part of someone who's a part of other verticals throughout the agency. So thank you both for your support in moving with alacrity and getting someone named to this position as soon as possible. I have no questions or comments now. Thank you all.
Thank you, Board Member Hood, and I certainly agree with you that we will work on filling this position. Also, one thing I am taking away from our discussions today is while we do an annual report for the CLF, we may need to increase its visibility and the content of that report going forward. With that said, is there a motion?
I second the motion. Oh, I'm sorry. Oh, man, I'm a mess at this, Bill. Some of us are visual learners and really need to do this in person. This is Vice Chair Hopman. I move that the board approve interim final rule part 725 of NCUE's rules and regulations for a 60-day comment period as attached to the board action memorandum.
Is there a second to the motion?
This is Board Member Hood, and I second the motion.
He seconds my second.
There is a sufficient second. All those in favor say aye.
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 Aye. All opposed say nay. The ayes have it, and let the record show the motion passed 3-0. The second item on our agenda today is interim final rule, part 700, 702, 708A, and 790, asset thresholds pertaining to large credit unions. Staff presenting, Scott Hunt, Director, Office of National Examinations and Supervision. Scott, the floor is yours.
Good morning, Chairman Harper, Vice Chairman Hopman, and Board Member Hood. And just before I go any farther, I want to make sure I'm received on the other side.
You are.
Thank you. Over the course of the pandemic, the agency has taken several initiatives to provide relief to credit unions, recognizing that they are facing unprecedented demands to serve members and stay safe and sound. In this spirit, I'm presenting a recommendation to approve an interim final rule that would grant relief to certain large credit unions. This rule would grant covered credit unions additional time to prepare for increasing regulatory and supervisory demands upon reaching $10 billion in assets. As background, the federal government's response to the pandemic has included significant stimulus payments and other financial assistance to many Americans. These funds, coupled with investors' flight to safety, has resulted in unexpected and exceptional growth in credit unions. For large credit unions, it has resulted in cases where growth pushed them across the $10 billion asset threshold quicker than they had planned. As determined each March 31, this $10 billion threshold triggers two supervisory consequences. Credit unions will be transferred to the oversight of the Office of National Examinations and Supervision, and it requires credit unions to meet the requirements of Part 702 regarding capital planning and stress testing. These events necessitate increased routine reporting to NCUA and also significant investments to meet the demands to prepare forward-looking risk analytics and risk mitigation strategies. In exploring this potential relief, the agency must ensure that such action is prudent, as larger credit unions can present greater risk to the Share Insurance Fund. For this reason, we explored how large credit unions invested this deposit growth. We did not find that the larger credit unions used these funds to take on proportionately higher risk. Generally, these deposits were placed in cash or investments, as there is some uncertainty on the eventual use by members. As a safeguard in the rule, the board will retain the right to deny this relief to a covered credit union under certain conditions, such as presenting a greater risk to the insurance fund. If the rule is approved, it will allow covered credit unions to measure assets as of March 31, 2020 for purposes of determining compliance with the capital planning and stress testing rules, as well as oversight by WUNS. This rule covers credit unions currently supervised by the regions as well as those already assigned to WUNS. This is a temporary measure. The measurement period will be reinstated March 31, 2022 for determining compliance thereafter. Recognizing this is an interim final rule, while comments will be solicited for a period of 60 days, the rule will become effective upon being published in the Federal Register. This concludes my remarks. I'd be glad to answer any questions of the board. Turning it back to you, Mr. Chairman.
Many thanks, Scott, for your presentation on the temporary rule on asset thresholds pertaining to large credit unions. The NCUA board is issuing this interim final rule to address economic disruptions caused by the COVID-19 pandemic. Late last year, our fellow banking agencies published a comparable interim final rule for certain banks. Before I begin, I do want to commend Vice Chairman Hauptman and Board Member Hood for bringing this matter to my attention and requesting that the board consider it. As a board, Congress expects us to consider the views of one another and to work together to develop good public policy for the credit union system. Thank you, Vice Chairman Hauptman and Board Member Hood, for your leadership on this matter. The rule before us today would mitigate transition costs on certain credit unions related to the COVID-19 pandemic by allowing federally insured credit unions to use asset data as of March 31st, 2020 to determine the applicability of certain regulatory asset thresholds during calendar years 2021 and 2022. Specifically, the interim final rule allows a federally insured credit union to use March 31st, 2020 financial data when determining whether the institution is subject to capital planning and stress testing requirements under the NCUA's regulations and supervision from the Office of National Examinations and Supervision. As financial first responders on the front lines of the COVID-19 crisis, many credit unions have experienced rapid and unexpected balance sheet growth resulting from government policy responses to and consumer choices resulting from the economic upheaval caused by the pandemic. In most cases, this growth is expected to be temporary and likely to change the unlikely to change the long-term risk profile of the affected credit unions. In fact, many credit unions, as Scott noted, are holding these new deposits in cash instead of higher risk long-term investments and member loans. The rise in federally insured credit union assets has resulted from several factors. For example, at the start of the pandemic, consumer spending decreased significantly as states or localities ordered Americans to stay at home to stop the spread of the virus. Additionally, market volatility led to a flight to safety during which securities investments became insured credit union shares. And as part of congressional action like the CARES Act, the U.S. government provided trillions of dollars in direct support to consumers and businesses. For federally insured credit unions just below $10 billion in assets at the start of the pandemic, these factors have resulted in their balance sheets burgeoning by an average of 14% and in one case, 34%. In contrast, in 2019, federally insured credit unions with assets just below $10 billion had an average asset growth of only 9%. The latest round of stimulus checks and unemployment benefits to Americans across the country will only continue this growth. As a result, some federally insured credit unions have been or may soon be pushed over the asset thresholds that could subject them to additional regulatory requirements. Because the asset growth was rapid and unexpected, many of these institutions have not adequately planned and budgeted for these transitions. What is more, some of them may eventually fall below the thresholds as government interventions subside and consumers return to more traditional spending patterns. Accordingly, this interim final rule gives affected federally insured credit unions more time either to reduce their balance sheets or to prepare for higher regulatory standards. There may be, as Scott pointed out, limited instances in which a threshold exemption would be inappropriate. To address such situations, under this interim final rule, the board may continue to use its existing reservations of authority to designate a federally insured credit union as subject to one's supervision or other stress testing and capital planning requirements. When making such a determination, the board would consider all relevant factors affecting a federal credit union's safety and soundness, including, but not limited to, the extent of asset growth, the causes of such growth, including whether the growth occurred as a result of mergers or purchase and assumption transactions, whether such growth is likely to be temporary or permanent, whether the federally insured credit union has become involved in any additional activities, and the type of assets held by the federally insured credit union. In instances when the federally insured credit union crossed the threshold due to a merger or a purchase and assumption transaction, the asset growth is planned and should be treated differently from unanticipated increases. In the case of the former, the credit union had the opportunity to plan and prepare for the change in regulatory requirements. In the case of the latter, it did not. Furthermore, the board may, in some instances, still require a federally insured credit union to conduct capital planning and stress testing in the absence of a merger or purchase and assumption transaction if significant asset growth at the credit union reflects a material change in the business model, risk profile, or complexity of the credit union. Nonetheless, we expect to apply the reservation of authority only in limited situations. Scott, in this regard, I do have one question for you. Of the federally insured credit unions that would be exempted under this interim final rule, could there be one or more that should not be exempted and instead brought under the capital planning and stress testing programs immediately?
That is a question. I've been consulting with the regional directors, and if we have such a case, we will reach out directly and expeditiously to that institution to make them aware.
Thank you, Scott. Thank you, Scott, for those insights. While the rule before us today affects large credit unions, we recognize that the latest stimulus payments resulting from the American Rescue Plan will soon lead to further increases in the assets and shares of smaller credit unions. The NCUA board, therefore, will soon consider a tailored, targeted, and temporary rule similar to last year's regulatory action to exempt credit unions from certain prompt corrective action requirements. Specifically, this rulemaking will allow the NCUA board to issue in a single order instead of multiple orders to waive the earnings retention requirement for any federally insured credit union classified as adequately capitalized. The rule would also create a streamlined process for submitting net worth restoration plans for a federally insured credit union that becomes undercapitalized primarily because of an increase in share deposits. I look forward to working with my fellow board members on that proposal in the coming weeks. That concludes my remarks. Vice Chairman Hauptman, you are now recognized.
Thank you, sir. I want to express my gratitude to the staff for the work done on this interim rule change. I'd like to thank the chairman and board member Harper for their support to place on the agenda. I'm supportive of the interim rule as it provides relief consistent with measures offered to similar-sized banks. More importantly, I support the change as it will allow credit unions nearing $10 billion threshold to thoughtfully and deliberately make the changes needed to comply with the significantly heightened reporting requirements. Normally, crossing the $10 billion threshold should be something one plans for carefully, given a substantial regulatory burden that comes with being over $10 billion. Hence, there's not much reason to be sitting on, say, $10.1 billion in assets. Larger institutions do, obviously, place a larger risk on the SIF. Nobody at NCUA is forgetting that. But today's action is in line with NCUA's efforts to provide temporary pandemic relief. The funds from the latest $1.9 trillion American Rescue Plan Act start arriving this week. Credit unions are dealing with the fact that no country did more cash assistance than the United States during COVID, even on a per capita basis. Previous stimulus programs have spurred more consumers to turn to credit unions for financial services. In the fourth quarter of last year, credit union membership grew to 124 million, with over 60% holding a checking account there, an indicator that credit unions are increasingly their primary financial institution. In 2020, Americans slowed spending, increased deposits, and paid down and/or refinanced debt. The Commerce Department reported that household savings totaled $3.9 trillion last month, up from $1.4 trillion a year earlier. That is a remarkable increase. But these changes in behavior are the result of the current environment and do not represent a threat to safety and soundness. We can also expect members to soon ramp up spending, as the American economy is the undisputed world champion at finding ways for consumers to spend money. By taking this step, NCUA is acknowledging the uniqueness of the situation and not making it harder on credit unions already stretched thin by the circumstances. This interim final rule will help credit unions nearing $10 billion to continue to assist members while thoughtfully planning for the future. And last thing, while we're talking about thresholds, we may want to continue our conversations around aligning incentives so NCUA can do what credit unions do, which is put resources where they're most effective. What I mean is that perhaps well-managed credit unions can earn a longer exam cycle, and those eligible for it could be of, we can pick the asset size, but something greater than it is now. If we can offer more credit unions the carrot of getting an 18-month cycle, only if they get high CAMEL ratings, then NCUA can focus on the more problematic institutions. Plus, those who earned the 18-month cycle would really want to excel in their future exams so they can keep the 18-month cycle. And those who didn't earn it would have an incentive to do better so that they, too, can move to 18 months. We get what we incentivize, so I'd like us to continue to examine what it is that we are incentivizing. That concludes my remarks. Thank you, Mr. Chairman, and I do not have any questions on this.
Great. Thank you, Vice Chairman Hoffman, for that set of intriguing ideas. Board Member Hood, you're recognized.
Great. Thank you, Mr. Chairman. And Scott, I'd like to thank you for your presentation and also our NCUA staff who worked on today's IFR. I'd also like to thank you, Chairman Harper, for working with my office and the Vice Chairman to put this rule on today's meeting agenda. This is something that I had staff working on in January, and I appreciate your bringing it to fruition and across the finish line today, sir. As has been stated, a similar rule was moved by the OCC, Federal Reserve, and the FDIC last December. Given the influx of stimulus deposits and other government stimulus programs, this only makes sense to provide relief for share growth that could be, in fact, temporary. Temporary share growth should not add credit unions to their regulatory burden, so I'm glad that we're moving forward. There are 5 credit unions that have crossed the $10 billion threshold since April 1st of last year. They are up to 4 more credit unions that are close to the $10 billion threshold, but we don't know for sure until March 31st. So while this will only impact no more than 9 credit unions at present, this will in fact still provide a modicum of regulatory relief. The biggest adjustment for credit unions entering the one supervision is preparing for the quarterly data submissions and the capital planning and stress testing rules. Providing a temporary reprieve is the right thing to do, especially in the midst of a pandemic. While I have no particular question on the interim final rule, I do have one related question, though, regarding thresholds. And Scott, that's regarding the NCUA frequently asked questions page. It's important that we have this on the record, I think. Do credit unions have to comply with the Durbin interchange fee and routing regulations for debit cards with the influx of deposits that put the credit union over the $10 billion threshold?
So thank you for the question, Board Member Hood. The short answer is yes, they have to comply, but the good news is when the banking regulators issued several relief efforts at the end of 2020, one of them did address the interchange fee cap that would kick in at $10 billion. And that is not specific just to banks. That actually it also applies to credit unions. So thereby, they're going to be afforded the same relief as their banking counterparts. And what the regulators did is they set the measurement period for $10 billion in compliance to be measured as of December 31, 2019. So it actually goes back even a year further. So they will look to 2019 assets to be for that interchange cap to be applicable for a temporary period of time. That concludes my answer, sir.
Great, thank you. And again, thank you for your leadership and all that you do with our ONES group members. With that being said, I have no further questions or comments. Thank you. I give the floor back to you, Mr. Chairman.
Well, thank you, Board Member Hood. And Board Member Hood, because you were the one who began work on this rule for the agency, would you like to make the motion?
Oh, thank you, sir. I move that the board approve interim final rule parts 700, 702, 708A, and 790 of NCUA's rules and regulations for a 60-day comment period as attached to the board action memorandum.
Is there a second to the motion?
This is Vice Chair Hauptman. I second the motion.
There is a sufficient second. All in favor say aye.
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 Aye. All opposed say nay. The ayes have it, and let the record show the motion passed 3-0. The third and final item on our agenda today is a board briefing on the Guaranteed Note and Asset Management Estate Programs. Staff presenting are Keith Morton, Southern Regional Director, Eugene Sheed, Chief Financial Officer, and Anthony Capetta, Supervisory Financial Analyst, Office of Examination and Insurance. And I also understand that you will be joined by Frank Cressman, General Counsel, for questions. Gentlemen, you may begin when you are ready.
Good morning again, gentlemen. This is Anthony Capetta. Keith, Eugene, Frank, and I are here today to provide you an update on the NCUA Guaranteed Note, the asset management estates of the 5 failed corporates, as well as information on the upcoming interim distribution for the U.S. Central, Members United, and Southwest corporates capital note holders. I'll note that we will post a slide presentation as well as our prepared remarks on the NCUA website. We have included throughout the slide deck links to where the details and supporting information, such as various schedules and tables and FAQs already exist that address what we are covering today. I'll also note that except where noted, the information in today's presentation is based on Q4 2020 data. The AME data used for determining the instrument distributions uses NCUA's audited year-end 2020 financials. It's also important to note that some of this information and the projections we are providing today represent point-in-time estimates as of the dates noted on the slides. Much of the information is generated using projected cash flows for the legacy assets, that is, the securities from the failed corporate credit unions, and are subject to change. The future cash flows of the legacy assets are projected by BlackRock based on proprietary models that consider key macroeconomic factors such as housing prices, markets rates, and unemployment levels, as well as a wide variety of current characteristics and historical performance variables at the asset level. NCUA will receive these projected cash flows over time, but they have not yet been realized and could vary significantly from projections. So with that, we'll begin by reviewing some background on the Corporate System Resolution Program. During the economic crisis, several corporate credit unions had come under severe liquidity and capital pressure in 2008 due to high concentrations of primarily non-agency residential mortgage-backed securities. As of 2009, the total unpaid principal balance for these distressed securities was $52.7 billion, but their market value was less than $22 billion. Thus, market losses from these corporates, ultimately 5 in total, would have exceeded $30 billion, an amount far in excess of the Share Insurance Fund's then $11 billion balance to cover losses. We estimated the probable failure of thousands of consumer credit unions with uninsured deposits in these institutions, which would have resulted in a cost to the credit union system estimated at $40 billion. The agency's Corporate System Resolution Program prevented that scenario. Stakeholders will recall that the Corporate System Resolution Program had 3 key goals: to stabilize, resolve, and reform the corporate system. The extraordinary liquidity support programs put in place during the stabilization phase of the program have all since expired, or in the case of the temporary Corporate Credit Union Stabilization Fund, closed early. But 2 elements of the resolution phase remain. specifically the NCUA Guaranteed Note, or NGN program, and the 5 asset management estates, 1 for each of the failed corporate credit unions. Slide, please. At its open meeting on September 24, 2010, the NCUA board announced the resolution phase of the Corporate System Resolution Program. To facilitate the resolution, there was an initial sale of about $10 billion in securities that were highly marketable and trading close to par, as well as the unwind of about $25 billion notional in derivatives so as to unencumber the legacy assets for re-securitization. Resolution of the 5 corporate credit unions employed a good bank, bad bank approach that led to the creation of 5 asset management estates and temporary bridge corporate credit unions, 4 of which have since been closed once operational transition for the affected credit unions was achieved. NCUA created a re-securitization program to provide long-term funding for the legacy assets through issuance of the NCUA guaranteed notes by trust established for that purpose. With the issuance of the NCUA guaranteed notes, NCUA transferred the associated legacy assets into their respective trusts. The NGNs are guaranteed by NCUA and backed by the full faith and credit of the United States. The NGN program began with the first deal issued in October 2010 and the last deal issued in June 2011. Other program milestones include the complete repayment of $5.1 billion in U.S. Treasury borrowings in October 2016 and the early closure of the Stabilization Fund in October 2017. We are currently nearing the end of Phase 3 and in the terminal phase of the Corporate System Resolution Program. In terms of future milestones, the last NCUA guaranteed note will mature on June 12, 2021, after which we will exhaust all legal remedies, complete the orderly liquidation of the remaining assets, close the AMEs, and distribute the remaining funds to stakeholders following the payout priorities. Note that there is no end date on the timeline. That is because, as I will show later in the presentation, from July 2021 on, NCUA will still have a significant amount of post-securitized legacy assets that remain to be monetized. NCUA will monetize these legacy assets seeking to obtain full and fair value for stakeholders through an orderly liquidation. Although the goal is to complete this process by the end of 2021, since there is no way to determine what future market conditions will exist at that time, the program may continue beyond then. Slide, please. NCUA issued a total of 13 NCUA guaranteed notes with several of the deals having multiple tranches or series. Ultimately, 18 series of notes for a total proceeds raised of $28.3 billion was issued. All of the NGNs, except the 2011 M1 deal, amortized based on a paydown of the underlying legacy assets. The 2011 M1 deal was a series of 5 bullet payments, 4 of which have been paid. The amount of the assets securitized from each of the failed corporates that are in each of the NCUA guaranteed notes are also shown in the table. All 5 of the AMEs have legacy assets in the last NGN that matures in June of this year. The NCUA guaranteed notes were backed by a variety of security types, predominantly non-agency residential mortgage-backed securities, and all were structured with final maturities of 10 years or less. This was done to achieve better execution and pricing for the deal offerings and to ensure that the NCUA guarantee obligation associated with the notes did not extend beyond the life of the Stabilization Fund. Slide, please. Slide 5 provides some high-level statistics on the current status of the NCUA guaranteed notes and the associated failed corporate legacy assets. In terms of trends, we use Q4 2011 as a reference point as it is the first year for which all the NGNs had been issued. This provides a comparable basis for totaling outstanding balances and so forth. Adding up the nominal amounts at the time a particular NGN was issued, we actually securitized over $40 billion of legacy assets with total proceeds raised through the NGN sales of $28.3 billion. At Q4 2011, the total legacy asset unpaid principal balance across all the NGNs was $34.3 billion. As of Q4 2020, this has declined to $4.5 billion, and that was primarily due to principal paydowns and defaults realized on the legacy assets. As you can see, the realized legacy asset losses from the legacy asset losses line is that $9.7 billion of realized losses have occurred to date, and the total remaining losses are estimated to remain stable around that value of $9.7 billion. This means that the vast majority of expected losses have already been realized. The net realizable value was $24.5 billion as of Q4 2011, with a market value of $19.3 billion, and at the time that was backing $24.7 billion in outstanding balances owed to the NGN investors. As of Q4 2020, the net realizable and market values of the legacy assets are now $2.9 billion, and that backs $0.4 billion owed to the NGN investors. Slide, please. This slide illustrates the maturity dates and the effective or actual guaranteed payments for the recently matured NGNs that occurred in Q4 2020 and Q4 2021, as well as the final remaining NGN, which will mature in Q2 2021 on June 12th. As previously noted, the NGNs were guaranteed by NCUA and backed by the full faith and credit of the United States. These guarantees provided for timely interest and ultimate principal at maturity of the NGN notes, and they were necessary for NCUA to issue the notes during the height of the Great Recession in 2010 and 2011 when the capital markets were in turmoil. These guarantees provided that if an NCUA guaranteed note deal reached its maturity date and did not have sufficient cash within the trust to pay off the remaining balance of the notes due investors, NCUA would supplement the trust and satisfy the note's final principal payment. Of the 13 original deals, or the 18 series of notes, 12 or 17 of those series of those notes have matured and one deal remains outstanding. Noted on the chart are the guaranteed payments associated with each of the maturities of the NGN notes, with the exception of the NGN 2011 R33A, which did not require a guaranteed payment as it matured naturally 1 month before its final hard maturity. For 6 of the deals shown, the NCUA executed optional purchases to retire the trust. These payments into the trust to purchase legacy assets underlying the maturing notes are functionally equivalent to guaranteed payments. They allow NCUA to access and manage them more efficiently and allow the deal to mature and pay a formal guarantee payment. The final NGN will mature in June of this year with an estimated formal guarantee payment of $78 million, and that will bring the total amount of guaranteed payments and optional purchases to approximately $3 billion. Slide, please. Slide 7 provides a summary of the legacy asset sales to date and the information on the assets that remain to be monetized. NCUA began an orderly liquidation of the assets in February 2017 and has successfully executed 29 auctions up to March 9th of 2021. We hold these auctions in a bid and wanted competition format among 35 broker-dealers of various sizes and abilities to ensure that we reach the breadth and depth of the market and obtain best execution for the sales. To date, our auctions have resulted in 25 different broker-dealers purchasing legacy assets at their full and fair market value. NCUA executes these auctions directly with the market to avoid paying fees to outside parties and maximize return to stakeholders. As can be seen from the upper table, as of March 9th, 2021, we've sold 632 bonds with an unpaid principal balance or face value of $4.7 billion, realizing $4.1 billion in sales proceeds, with the average sales price approximately 6% above. And correction there, it was a face value of $4.9 billion, realizing $4.1 billion in sales proceeds with an average sales price approximately 8% above our net realizable value or book price. The lower table shows the numbers and amounts of bonds that remain to be monetized. Currently, both securitized and post-securitized by the program's end. As you can see, there are 662 legacy assets remaining with a projected net realizable value of approximately $2.1 billion. It is important to note that many of the remaining legacy assets are held while NCUA pursues legal remedies with various counterparties. In the interest of maximizing return to stakeholders, these assets are not available for sale until we have fully exhausted or settled the efforts. By count, approximately 1/3, and by market value, approximately 1/2 of the remaining legacy assets are part of these efforts. NCUA will complete these efforts as soon as practicable, and we are continually evaluating the efforts and balancing them with the likelihood of success in our decision to continue to pursue them. Slide 8, please. This table shows the total gross and net corporate system resolution costs, as well as how those costs are broken out between federally insured credit unions and depleted corporate capital holders. As of Q4 2020, the projected lifetime legacy asset losses are $9.7 billion, as shown here and back on slide 5. Due to the guarantee fees earned by insuring the NCUA guaranteed notes and the beneficial excess interest from the underlying legacy assets, we expect $1 billion to offset those lifetime losses, resulting in a total gross projected resolution cost of $8.7 billion. After accounting for direct legal recoveries received of $3.8 billion, the total net costs are projected to be $4.9 billion. Thus, in addition to preventing losses and stabilizing the credit union system, the Corporate System Resolution Program, including the NGN program, provided beneficial excess interest and guarantee fees and preserved the rights to what ended up being several $billion in additional legal recoveries. I will now turn the presentation over to Keith to talk about the AMEs and the flip side of these costs, and that is the projected recoveries to corporate capital holders and any planned interim distributions. Keith?
Thank you, Anthony. This is Keith Morton. The Asset Management Assistance Center is charged with the administration of the asset management estates, as shown on slide 9. As liquidating agent for each failed corporate, the NCUA manages independent books and records for each estate. A separate accounting for the estate's assets, liabilities, recoveries, and expenses is maintained to ensure we protect the interests of the respective creditors, claimants, and members. Anthony just described the NGN program, its current status and plans going forward, and the successes achieved. The NGN program has played a critical role in NCUA's corporate system resolution program, effectively mitigating losses to the National Credit Union Share Insurance Fund and maximizing investment return while enabling the agency to aggressively pursue legal recoveries totaling $3.8 billion to date on a net basis. At the outset of the NGN program, projections indicated the members of the failed corporates would not likely receive any recoveries for depleted capital. However, the program has been very successful to date and has positioned the liquidating agent to again make distributions to the former capital holders of U.S. Central, Members United, and Southwest corporates totaling $368.7 million. Next slide, please. This slide depicts how Part 709 of the NCUA's rules and regulations govern AMAC's administration of the asset management estates. Going from left to right, A1 to B9, we show the priority of payment as defined by the regulation. In paying out insured shares, expenses of the liquidation, NGN program costs, the Share Insurance Fund became the claimant under B1, B4, B6, and 6.5. With respect to U.S. Central, Members United, and Southwest, all claims have been paid or provisioned for up through the B6.5 level. Westcor is not projected to be able to repay the Share Insurance Fund's claims, which make up $3.2 billion of the $3.3 billion shown on the slide as B1, 4, and 6 claims. Thus, we do not project any recoveries to Westcor's former capital holders. Constitution has remaining liquidation expenses to be paid at the B1 level and to the Share Insurance Fund at the B6 level, which in aggregate total $60 million. These claims must be paid or provided for before any capital can be distributed to its former members. Per regulation, all senior claims up to and including the B6.5 level must be paid or provisioned for prior to making a distribution to the membership capital and paid-in capital claimants, which fall into the B7 and B9 categories. Depleted capital claims total $4 billion. Slide 11, please. This slide reflects the depleted member capital and paid-in capital at the time of liquidation and corresponds to the claims capital holders have against the corporate asset management estates. The four failed retail corporates, Westcor, Members United, Southwest, and Constitution, have claims totaling $700 million against U.S. Central. In addition, other capital holders of U.S. Central at the time of liquidation, primarily representing operating corporates, had claims totaling $1.3 billion against U.S. Central, which are shown as 2 network on slide 11. The slide also reflects the depleted capital at each of the four failed retail corporates. Please note the totals don't add due to rounding in billions. The right-hand side of the slide shows projected depleted capital repayment for each of the asset management estates. In total, this equates to $2 billion of recoveries to the credit union system based on respective claims against the estates and projected distributions as of December 31, 2020. The $600 million in projected capital repayment from U.S. Central, as shown on this slide as 2 corporate AMEs, is with respect to the claims Westcor, Members United, Southwest, and Constitution have against U.S. Central, representing the capital they had at U.S. Central that was depleted at liquidation. The $600 million projected capital repayment to the 4 retail corporates, AMEs, as shown on the slide, flows through their respective asset management states and to its capital holders per the payout priority schedule previously discussed. Please note that it is already factored into the $2.2 billion in projected recoveries as shown as 2 network on the slide. In summary, we project the former capital holders of the failed corporates will receive $2.2 billion of the remaining $4 billion in depleted member capital, paid-in capital. This also includes, the 2.2 includes $300 million in bonus dividends, which I'll cover on the next slide. Finally, this slide also reflects the percentage of legal recoveries to projected capital repayments for illustration purposes only. As previously mentioned, the NGN program provided NCUA as liquidating agent time and standing needed to pursue legal recoveries. In total, the estates were awarded $5.1 billion in damages to date, netting $3.8 billion in recoveries. The legal recoveries due Westcor reduced the Share Insurance Fund loss attributed to Westcor as the fund stands in a senior's claims position to the former capital holders of Westcor. Slide 12, please. I'm sorry. Next slide, please. At this point, I should pause to issue standard caveats and disclaimers about these projections. All projections are point-in-time estimates, economic and/or market conditions that involve greater volatility in one or more factors used to project realized values as compared to those the stress scenarios model can lead to less than projected recoveries. On slide 12, you can see that it's now projecting all scenarios that U.S. Central, Members United, and Southwest Corporate will each have funds available to repay some portion of member capital after anticipated cash flows are applied to each estate. As previously mentioned, repayment of U.S. Central member capital will include a distribution to the other 4 states that had capital at U.S. Central. You'll also notice the projections are made under several scenarios derived from BlackRock projections in the adverse scenario represents a moderate recession. Next slide, please. On slide 13, we now project former members of U.S. Central, Members United, and Southwest Corporate will recover 100% of their member capital shares. Constitution is projected to receive 53% under the base scenario, and Westcor is not projected to receive a distribution under any scenario. One additional point, the liquidating agent also is projecting a liquidating dividend totaling $307 million to Southwest and $14 million to the former members and capital holders of Members United. Slide 14, please. The performance of the legacy assets and projected availability of funds has led us to consider whether potential interim distributions are appropriate. As liquidating agent, AMAC would only make distribution to depleted capital holders once senior claims are fully repaid or provisioned, and only if fiduciary cash for the given estate is available to make the payments. We have determined that U.S. Central, Members United, and Southwest Corporate have sufficient fiduciary cash as of year-end 2020 to make a distribution. Slide 15, please. Based on year-end December 31, 2020 audited financials, the liquidating agent is prepared to make an interim distribution of $150 million, $126.2 million, and $92.5 million after provisioning for known liabilities to the former capital holders of U.S. Central, Members United, and Southwest Corporate, respectively. Members United and Southwest have claims against U.S. Central for its depleted capital. Thus, of the $150 million in approved distribution to the former capital holders of U.S. Central, Members United and Southwest will receive $24 million and $21.1 million, respectively, as shown on the slide. With this distribution, members of Southwest will have recovered $264 million of their $403.5 million, or 65% of depleted member capital to date. As the Corporate System Resolution Program nears its final stage, the liquidating agent will continue to orderly liquidate securities not subject to litigation holds, continue to aggressively pursue the remaining legal cases, and continue to evaluate and make timely distributions of cash to the capital holders. And with respect to distributions, the liquidating agent is planning to make another interim distribution later this year based on June 30, 2021 results, subject, of course, to the availability of funds. We will continue to make distributions as appropriate every 6 months until the program is terminated. I'll now turn it over to Eugene, who will discuss the upcoming distribution. Eugene?
Thank you, Keith. This is Eugene Sheed. The NCUA issued certificates to member capital account holders in 2010. U.S. Central, Members United, and Southwest Asset Management Estates had over 2,600 member capital holders at the time of liquidation, almost all of which were credit unions. As a result of subsequent merger, purchase, and liquidation activity, we estimate there are about 2,000 current credit unions that will receive distributions. Updated FAQs and related information regarding this distribution will be posted on NCUA's website following today's meeting, which will include more details concerning this distribution and guidance on matters such as how credit unions should record the distribution. Our plan is to send letters to the remaining account holders in early April that will notify them of their amounts and other payment details. Distribution of the capital recovery funds is anticipated to be completed by April 30th of 2021. We have banking information for most account holders, and we will use that information for the distribution. For those recipients, particularly non-credit unions, we'll work to obtain any needed additional information from them. This concludes our presentation, and we would be happy to answer any questions you have. Over to you, Chairman Harper. Thank you.
Thank you, Eugene, as well as to Anthony and Keith for your presentation. And a special thanks to your teams as well for their careful stewardship of the NCUA Guaranteed Notes Program and the asset management estates of the 5 failed corporate credit unions. Today marks a critical milestone in the Corporate System Resolution Program. With the last NCUA guaranteed note scheduled to mature in June, we are nearing the end of this landmark initiative that allowed the credit union system to absorb over time the failures of U.S. Central, Westcorp, Southwest, Members United, and Constitution corporate credit unions. A decade ago, very few of us could have imagined that the NCUA would return any funds, let alone 2 rounds of distributions, to the former capital holders at these 5 failed corporates. And we still have the potential for other distributions in the future. The success of the NCUA Guaranteed Notes Program is a testament to the leadership shown by the previous NCUA chairman and board members who supported this program and our recovery efforts over the years, even when it seemed the chances were remote for the Corporate System Resolution Program to end with any distributions to capital holders. This success is also testament to the efforts of the NCUA staff over the last decade. Their wise actions, careful management, and perseverance gave the NCUA the ability to manage and reduce potential losses to the system. These exceptional efforts contributed to the least cost resolution of the corporate crisis and have allowed us to recover and return nearly $540 million in depleted capital, with more distributions likely to come. Thank you all for a job well done. To be sure, there are other factors that have contributed to the success of the resolution program, including a persistent low-rate interest environment and rising house prices over much of the last decade. The shrewd decision to pursue litigation against the Wall Street firms that sold faulty mortgage-backed securities is also a key reason why we are now making distributions. Indeed, without those sizable legal recoveries, there would be no checks sent to capital holders. As we wind down the remaining asset management estates, we will continue to minimize costs and maximize returns. In doing so, we will fulfill our fiduciary responsibilities as both the conservator and liquidator of the failed corporate credit unions and return even more funds to capital holders. That money, in turn, can be used to assist and make loans to the millions of credit union members experiencing economic hardships because of the COVID-19 pandemic, especially to people of color and those in low-income areas disproportionately affected by the pandemic. Given the cooperative philosophy at the heart of the credit union movement, credit unions have a moral obligation to step up and help these communities recover and start anew in the many months ahead. Thank you again, Anthony, Eugene, and Keith, for your briefing today, as well as to you, Frank, for being available for questions. I now recognize Vice Chairman Hauptman.
Thank you, Chairman, and thank you, Keith and Anthony, for the briefing and the work you and your team have done on this program for years now. I'm sure this is welcome news for many credit unions. I realize that when the Corporate System Resolution Program was developed, many did not believe a distribution would materialize. At the time, credit unions had written off their investments, and initial projections predicted no recoveries for holders of the depleted member capital at the affected corporates. It's my understanding that, although not formal, the pledge made to credit unions at the time was, when we get to the end of the program, if there's money left over, it'll be returned to you. And I fully appreciate the difficulties faced by the entire credit union system during the Great Recession. The Herculean efforts and difficult decisions made to ensure the safety and soundness of credit unions are undeniable, and I'm grateful to be here now. Thankfully, since the establishment of the CSRP and the NGM program, recoveries have exceeded expectations, and NCUA has been able to return funds to membership capital holders of the Southwest AME last year. Today, we expect to distribute funds to membership capital holders of the U.S. Central, Members United, and Southwest AMEs in 2021. Question for you guys. We know how many corporate AMEs this impacts. Can you just remind us how many credit unions hold claim certificates and how many can expect a distribution? Is it around 2,000?
So Vice Chairman Hauptman, thank you for the question. This is Eugene Cheed, and I'll take that one. So yes, the NCUA issued certificates to member capital account holders back in 2010. So we've got a record of who's entitled to the distributions. U.S. Central, Members United, and Southwest Asset Management Estates had about 2,628 capital member holders, of whom 2,559 were credit unions at the time of the corporate liquidations. That number shrunk over time because of subsequent mergers, purchases, and liquidations, to where, as you just mentioned, we're estimating that there will be about 2,000 current credit unions that will receive a distribution. Part of what we have to work through at this point, and what the staff is working on, is reconciling all that merger activity to ensure that the continuing credit unions receive the claims associated with those merged credit unions. That concludes my response.
Thank you, sir. How and when will this be communicated? Meaning, dear Credit Union X, on about such and such date, you're going to receive such and such dollars in such and such a manner. Can you walk me through that?
Yep, sure. This is Eugene Feed again, sir, and I'll be glad to take that. So a couple of things that we're going to be doing. First, we've been working on information that will help the credit unions understand a lot of what you just described, with a series of questions and answers and other information that we are ready to post on the website, which I believe will go up this afternoon. In addition to that, we are going to write each of the credit unions individually to indicate to them what to expect to receive, and we expect that'll happen within the next few weeks as we finalize the specific amounts going out to each of them. And then we expect to make payment to them by the end of April. And we'll also have on those communications information where they can contact us if they have questions or would like some additional assistance. That concludes my answer.
Thank you, sir. Excellent answer. And I got a question here about, that's my last question, about prior communication. And the question stems from the fact that there are credit union CEOs, at least as of last week, who are unaware that they're about to get a substantial amount of money. That situation obviously be detrimental to a credit union's planning process for hiring decisions, for the pricing of products, et cetera. Now, we can argue that a credit union should be aware, but they obviously have other priorities. And it's obviously our job at NCUA to bring this to their attention in a manner that works effectively for them. Now, we all agree that the exact details of these payments isn't available until they've been truly calculated and verified, sure. But we can still communicate straight to CEO inbox a steady drumbeat of information about the ballpark amount and timing of any distributions. Can you describe, prior to now, the communication direct to the credit unions regarding these funds, ballpark amount, ballpark timing?
You mean with respect to this distribution that we're prepared to make today? This is Keith Morton, by the way.
Yeah. Yes, Keith. Good to hear your voice.
Yep.
And yes, that's what I'm talking about. Yeah.
Yes. So yeah, great question. So last summer, I believe it was June, I made a presentation to the NCUA board where I walked credit unions through the process NCUA uses to determine the distribution amounts. And that was also included in our PowerPoint presentation during that board meeting. That distribution is based on the fiduciary tables of the estates, of the asset management estates, which we maintain quarterly on our NCUA website. Now, due to a timing difference, the December, there's always a lag because we have to wait till the quarter end is produced and then verified. But we post those on the NCUA web as soon as they're available. So they have been out on the web for a few weeks now, indicating, at least the details with respect to claim and recovery information, the fiduciary tables, and payout priority schedules for each of the corporate asset management estates. So largely, a credit union can go out there, look at the information, and look to last year's presentation on how we calculated it to calculate it again. We also include that same information out on our website in the form of what our corporate distribution process is and the FAQ. That was put out last year when Anthony and I briefed the board on the distribution that was, at that time was going to Southwest Corporate. Unfortunately, as you pointed out, we don't know until we get to the end of the period what the actual cash position is going to be. And since we're trying to make the distribution as meaningful as possible and as large as possible, we want to sit down, calculate that and determine what the distribution should be and what we're comfortable doing. In this case, making a distribution of all the available cash, less the liabilities and senior claims. So that concludes my remarks, sir.
Thank you, sir. But when we finally make these distributions, I assume there is some communication to the credit unions directly, either by paper, snail mail, or you have email addresses for these institutions?
Yes, sir. Yeah, as Eugene just mentioned, we're going to personally write each of the credit unions and communicate to them what the distribution amount will be. And that'll go out in the next couple of weeks.
But when you say write, what does that mean? Does that mean a physical envelope with paper in it? Or do you mean email?
Yeah, both. We
Okay.
usually send it through both means, electronic and physical hard copy.
Gotcha. And that means that we've got information, could be outdated, but we've got information on how to communicate with these credit unions. So my question is, all that stuff you said was put on the website and then it was updated,
Yes, sir.
Did we send that information to them using these same communication channels you just mentioned?
Following last year, I believe we did. I'm not sure if we included, I'd have to go back and look. I know in the letter, I don't believe we referenced the web page, but we didn't include that same information that was out on the web page that I just described. So we referenced it in the communication to the credit unions and provided a link to them that they could use.
Okay. And
I'll just point out, I mean, I hear your thoughts on this, and I'll sit down with my team to see how we can possibly enhance the process for communication going forward. I recognize the importance of the matter and pledge to look into the matter and see what we can do to actually further enhance our communication with the stakeholders in this matter.
yeah, I think we agree that they shouldn't have to come to us, meaning, magically know our website was updated, find it on the website, know it's there. We should bring it to them, right? We work for them. They don't work for us. And let me follow on that. Again, I totally understand we don't know the exact details, and you want to be correct in everything you say, and you want it to be as large as possible, as you mentioned. Was there a way to ballpark within a 30% range either way, the total amount, the average amount, or the amount for each institution, like a few months ago, a year ago? Like when you say you're calculating, are we talking about you might get $2 and you might get $1 billion, or is this like? You know what I'm saying? If somebody said,
yeah, no.
if I was getting $10,000 next month, I'd want to know that sometime next month I was going to get around $10,000. Whether it's $9,800 or $10,100 isn't that important, but it would definitely affect how my family plans for the future.
No, I certainly appreciate that. The challenge herein lies that the funds that largely drive the distribution come from the monetization of the underlying post-securitized assets.
Right.
So until those sales actually take place, we don't, and they're reflected in the financial statement, so we can calculate the current cash positions and the liquidity positions as of a point in time, in this case as of year end, then we won't have that information. So technically, I mean, and what I advised the creditors last year was that we would make a determination using audited financial statements to ensure we are as accurate as possible, and that the audited financials are typically available around mid-February. So we're talking that they were available about mid-February, and that led to us developing this presentation before the board to share with you what we intended to do, or the distribution we intend to make to the industry.
Okay. And I'm aware these assets aren't super liquid, so it's not that easy to know what price you're actually going to sell it at. I understand that. But say 6 months ago, could you have made an educated guess, within a standard, interval of, 25% either, one way or the other, of how much the average credit union would get, like what the pot of money would be?
I'm going to have to defer, see if Anthony can jump in on this one. I'm not sure.
Sure.
I would have that information, but Anthony,
I get it. You don't know what you got till you sell it, and you have the cash in hand. Totally understand. But I guess what I'm trying to get at is just ballpark, timing and amount, just ballpark.
Right. I think we generally have good information on the expense side. So the question then is, and the claims as we include on our recoveries and claims schedule. But Anthony, can you please speak a little bit more to the challenges on the investment side and valuations there?
Yeah, we're not selling Bitcoin here. It's not going up and down 20% a day. I'm just trying to get a ballpark.
Agreed, and thank you, Keith. I will take this. Actually, last year is what I would say the ideal reason why you would not want to offer up a projection for what could be paid and when it might be paid. As we've discussed many times today, and the chair and others opened the meeting with, we experienced the COVID crisis. In our post-securitization sales and our orderly liquidation process that we were initiated at the beginning of last year, everything was going along fine. And had you asked me in February what I thought we could do in terms of monetizing those assets by the end of the year, I could have provided a value that was hundreds of millions of dollars different than what we actually did. Because of the COVID crisis and the disruption to the markets, we were unable to sell assets and conduct this orderly liquidation from basically March until September, when the market finally normalized. And in our assessment, we could obtain values either at or better than what our book value was. So I would just say on the monetization portion of it, as Keith had indicated, although we can project what we think these assets are worth, and we do that with what we believe the net realizable value is, should the market experience some kind of turmoil like it did, or for some other reason, the general macroeconomic conditions as a whole, deteriorate, we would have no way to say how much we would be able to provide.
That's a terrific answer. Was it communicated to credit unions?
In our brief that we provided last year, when we discussed the legacy asset sales, we discussed how, because of the market crisis, we were no longer liquidating assets. Further, on many of the webinars or meetings that we had met or participated in with the corporates, we had discussed the status of our sales efforts, and to not only inform them, but to also make sure that they understood that we were not just simply selling assets because we wanted to close a program in a down market.
When you say inform them, do you mean discuss it at the board meeting, do the presentation, and then put information on our website, or was it brought straight to their inbox?
I had participated in several web meetings with the corporates, let's say, where that information was distributed. If it had gone out widely to all credit unions, that I can't speak to.
I should clarify. The communication with the corporates, I think, is really not part of my discussion. It's the downstream people that have year-altering amounts of money coming to them that don't know when or don't know how much. And your answer about, well, we have the situation in COVID and the values are going around, all of that would be useful. But let's put aside dollar amounts now and just talk about timing. You said the longest maturity was 10 years, right, in 2011, so we're here in 2021, right? It's not a coincidence that, this discussion is happening 10 years later in 2021, correct?
the NCUA guaranteed notes all had hard final maturities that extended no more than 10 years. Yes, that's correct.
Right.
The fact that we are monetizing those securities now is not necessarily a surprise, because they had, in fact, as we've reported over the last several years, been performing better than expected. Initially, when the program was created, and what had, for a big part of the program, NCUA was likely or had planned to hold these assets to maturity, which would be 30 years from their issuance date, which was 2005, 6, and 7. Out 30 years would be to 2035. So somewhere in between when the program ended and the fact that we were monetizing the assets instead of holding them to receive all the principal and interest that we were projecting would be provided up to 30 years later, we have decided to monetize them.
No, I hear that, and I have nothing but praise for the manner in which these assets were managed. I guess I'll leave you with my final comment, and I'll stop talking, which is that whenever you found out they were monetized and you knew that money would go out the door in the second half of 2021, the credit unions who might get some of that money should have that information pushed out to them the next day, because it's just, I know I'm pounding the same point here, but sometimes in government we say, well, it's on our website, you should come to us. No, it's our job to bring it to them, and maybe they should pay attention to our board meetings, but the reality is we have to work with their life, not ours. And so the notion that you may get some money this year of a fair amount is something that pretty soon after we know it, they should know it and communicate it directly to them. But I appreciate the comments about reviewing the communication and going forward for similar situations. I've taken up plenty of time, and no further comments. Back to you, Mr. Chairman.
Thank you so much, Vice Chairman Hauptman. Board Member Hood, you're recognized.
Great. Thank you, Mr. Chairman. When I was on the board leading up to the corporate crisis, it's hard to believe it was over a decade ago, we didn't quite know what to expect. And while the corporate resolution program was put in place well after I left the agency, we are still dealing with this issue and the fallout from it, although it's winding down. I'd like to take this time to recognize the leadership of those previous board members who really did put us in a position to get some of the recoveries that we're discussing today. I don't think any of us at that time thought that we would be in a position to recover some of those funds. Keith, although we are making great progress, can you please make a commitment to get this NGN and A&M program fully resolved as soon as possible?
Yes, sir. We're working hard to bring this final phase of the NGN program to a close. As Anthony pointed out, of course, it requires the monetization of remaining assets and the resolution of the remaining legal cases that we primarily have against the trustees. So there's still more work to be done, sir, but yes, I pledge to resolve this as soon as possible.
Great, thank you, sir. And I do know a lot of this you discussed with the Vice Chairman, but for the distribution as discussed today, when can credit unions expect to be paid? Just for the record, please.
Yes, we plan to effect a distribution of $368.7 million to the former capital holders in April.
Great, well, thank you. As you know, the faster this can be resolved and the more transparent we can be, the better it is for the overall credit union system. So thank you for your hard work and leadership. I do have a few other questions as well. And one is on the audit of the NGNs. The auditor states, and I quote, "We do not express an opinion or provide any assurance on the information because the limited procedures do not provide us with sufficient evidence to express an opinion or provide any assurance." Could someone please elaborate on what that actually means?
Sure, sir. This is Eugene Sheet, and I'd be glad to elaborate on that and how the NGNs are a part of our audited financial statements. So the comment, the quote that you just cited does come from the auditor's report. However, it very specifically references a section of the report that actually precedes the audited financial statements and footnotes, and that's called the Management Overview section. And that's a section that NCUA presents in the front of our audited financial statements. And its purpose is to help the reader better understand the context of the financial statements, including things like the economic conditions and other relevant, important information to understand what's contained in the financial statements. And that Management Overview section is required under applicable federal accounting standards for this fund. The auditor, as they note in their report, they apply certain procedures over that section, but that particular section they do not specifically express an opinion on. That said, the auditors do express an opinion, as you know, on our financial statements and the accompanying footnotes. And that includes all the relevant NGN activity and also reports on our fiduciary activities. On these items, the opinion, as you know, is that the financial statements are fairly presented in all material respects for the Share Insurance Fund. The NGNs figure prominently in the financial statements, both on the face of the statements as well as in the explanatory footnotes. Most notably, I would point interested readers footnotes number 7 and number 14. A lot of the information from those footnotes in the face of the financial statements actually does show up in the management overview. So while the auditors are essentially providing an opinion over that front section, they do provide an opinion on the financial statements themselves, from which a lot of that information is drawn. Thanks for the opportunity to clarify. Back to you.
Great, thank you, Eugene, for that very thorough response. And this is another question. I don't really want to completely relive what happened over a decade ago, especially because at that time, as I've mentioned, no one was sure that there would be recoveries of this size or any size for that matter. But could someone please talk about the use of outside law firms being paid on contingencies and perhaps what some of those law firms are?
Sure, Mr. Hood. This is Frank Cressman. I'll be glad to take that question. At the time that NCUA engaged law firms to handle our securities litigation, it was done on a contingency basis. There were two firms that were hired at the time. They are Kellogg Huber and also Corin Tillery. These two firms are still working on cases for us, and to date, they've earned fees somewhere north of approximately $1.2 billion, and I think that approximates to about 23.5% of the monetary recoveries we have so far. That concludes my answer.
Great, and thank you, Frank. And for those recoveries, I know some of the folks that we have had litigation against, but I don't see any mention at all of going after the rating agencies that were involved with these transactions. In fact, when I was chairman or vice chairman at that time, I was really concerned that Fitch, Moody's, and S&P got off relatively scot-free, whereas some of the other stakeholders in the ecosystem, they have in fact been sued and they've been litigation, and again, we're getting recoveries. But could someone maybe mention, maybe it's you, have we done any litigation against the rating agencies themselves?
This is Frank. I'll take that question also. You're correct. The lawsuits that we filed against the securities issuers and the trustees do not include any suits against the rating agencies. As far as I am aware, none of the federal agencies have filed suit against the rating agencies. That concludes my answer.
Great, thank you. And again, it's just been one of my concerns for quite some time. Again, everyone else admitted some of the fault, and there was fault to go around, but again, they did get off relatively scot-free. But now I've digressed. Thank you for talking about the fees that we have, I guess, the fees that the attorneys have gotten. Have we ever attempted to renegotiate some of those fees? And I ask that just because of $1.3 billion that's gone to them. Now, I recognize that doesn't mean that we would have gotten that without their assistance, but have we looked at any way at all of renegotiating those agreements? This
is Frank. I will take that answer also. the best answer that I can give you is I really do not know for certain. I have not been involved in either the hiring or the continuing negotiations with the law firm until I recently became general counsel. I was not involved in the litigation aspect of our processes. So I honestly don't know if any renegotiation has taken place, but I can certainly find that out for you if you like.
That would be really helpful.
Answer.
Thank you, Frank. That would be really helpful. And then again, recognizing that you are our newly appointed general counsel, I don't know if you could answer this. Does the general counsel's office have special contracting and spending authority?
So the general counsel's office does in fact have delegated authority under NCUA's delegations to select outside attorneys for both our liquidation and conservative function, as well as representing the agency in its agency capacity. So in that regard, yes, we do have procurement authority. That's the end of my question, my answer.
Okay, thank you, Frank. And this may go back again. I just want to ask, I recognize you're new, but if you've had any knowledge at all in terms of was the contract for the outside law firm competed or was it sole source? And again, just trying to get a feel here.
Sure. So within OGC, we do have procedures that we go through when we issue procurements, especially the hiring of outside counsel. My understanding is in this circumstances, because of the extenuating circumstances and the lack of time to take action, as well as the special skills of the two firms that were hired, my understanding is that it did not go through the normal competition process that we would normally do under our procurements. And that's the end of my answer there.
Great, great. And again, this is not to cast aspersions or to place blame in any area. I just, again, I'm trying to figure out what we can do as a board, since it appears that we are held by actions of a previous general counsel that was well before your time and previous contracts that were negotiated by previous boards. So that's a lot of the reason why I'm asking this today. So thank you. One other question that I do have, and then Eugene, this may be either for you, and actually I have two more. Could someone please explain how the payout affects the capital ratio or health of the National Credit Union Share Insurance Fund for members of the public who may be watching today? I know when we mention some of the payouts, I'm always wanting to make sure that folks know that it in no way impairs our share insurance fund. Could someone speak to that?
Sure.
Yes, sir.
Oh, go ahead, Keith.
Go ahead, Eugene. You can take it.
Sure. Mr. Hood, you are correct. The funds are fiduciary funds. They're not calculated as a part of the equity ratio. And so after a distribution is made, that distribution would have no impact on the equity ratio of the share insurance fund. Back to you, sir. Great.
Thank you, Eugene. I think, Keith, this is a question I think is probably best suited for you. I know you said earlier that a portion of the payout from U.S. Central will be paid to Southwest Corporate and Members United. Any idea of what the total distribution from Southwest Corporate and Members United will be and what's going to be expected for the shareholders in April?
Yes, this is Keith. Let's see if I can have Edwin perhaps go to slide, probably best it's slide 15, please. This slide, and apologize, I don't have it up on my screen yet, but there it is. This slide shows that the distribution will be $150 billion to the former capital holders of U.S. Central, 126.2 to the former capital holders of Members United, and $92.5 million to Southwest.
Thank you. I would just say in closing, thank you, Keith. I would just want to say in closing, we all as an agency and we as a board today should be proud of what we have accomplished. but I think it does beg the question, and that is, what have we learned for the next liquidity crisis, for that matter? So, Mr. Chairman, I think this is the appropriate time to examine what went right and what went wrong with the NGN and AMEs winding down with the corporate crisis over a decade ago. The next liquidity crisis will come, and we should use this as a learning opportunity. So I just ask that you and the Vice Chairman, that we all look at lessons learned and what do we do to bolster our internal procedures to address anything that may come our way in the future. That's it. Thank you.
Board Member Hood, thank you for those really good and detailed observations and questions. I completely agree with you that it's appropriate for us to do a look back to assess what we did right, what we may have done wrong or could have done better. Not that we necessarily did anything wrong along the way. And I think it's also important to remember this wasn't just a liquidity set of issues, but there were also insolvencies involved here, and you have to weigh both sides of the coins as you look at our look back period. I also want to agree with you about the culpability of rating agencies. I know that when I worked on Capitol Hill and we were considering reforms that were ultimately incorporated into the Dodd-Frank Act, there was broad consensus amongst many members on the culpability of the rating agencies and the need to tighten things up there. And so I do know that there are at least regulations on that front. And then finally, I just would like to make a point that as we work to resolve things as soon as possible, we also need to do so in an orderly manner. We don't want to sell things at fire sale prices necessarily, and we want to make sure that we optimize the recovery and maximize the returns. So, you know, it's both speed and efficiency, but balancing it with best execution. And there might be some little tension there, but we should do it as quickly as possible. With that, that is the end of our meeting today, and there is no further business, so we are herefore adjourned.